This is the second of 3 videos we've created with financial to-dos after a spouse passes away. The first video covered near-term activities, things that need to get done in the first month or so after the death. This covers intermediate-term activities, things that don't need to be addressed immediately, but need to get done within the first year or so of a spouse's passing. My name is Rick Wechter. I'm the founder of Old Peak Finance. We are a comprehensive financial planning firm based in Chapel Hill, North Carolina, and working with clients nationwide. And we've worked with a number of clients who faced exactly this challenge. I mentioned a previous video which covered near-term actions like securing your cash and financial position, obtaining death certificates, claiming benefits, including Social Security, and confirming healthcare insurance. Now I want to look at intermediate-term steps. I will scroll through what's on the other video and get to intermediate-term actions. 4 items listed here and a couple more to follow. Settling your deceased spouse estate, updating asset titles, the naming, legal ownership of the assets, creating a financial plan, and updating your own estate plan. Settling your spouse's estate, which typically needs to get done, if at all possible, within 9 months of the passing. Now, settling your spouse's estate, which typically needs to get done within 9 months of your spouse's passing. This basically is the process where you move ownership of a particular asset from your spouse to you or whoever is now going to become the new owner. And there are 4 different ways this could happen, depending on the instructions that were attached to the asset that your spouse owned. Number 1 is an automatic inheritance. So an example of this is a joint account at a bank, which is typically joint tenant with right of survivorship. It automatically becomes the owner of the surviving spouse without any legal paperwork. So that's the first example. Houses typically follow the same procedure through a slightly different form of ownership, but very similar, called tenancy by the entirety. The second process of estate transfer would be relevant if your spouse owned assets in a trust that he or she had set up. Then you simply look at what the trust instructions are as to who becomes the new owner. And if, for example, your spouse had a brokerage account in the name of his trust, then you would simply show that trust agreement to Schwab or whoever the brokerage company is where the account is located, provide them with the death certificate, and they would effect the transfer from the trust to whoever becomes the new owner. The third method of transfer, also quite common, is if a beneficiary is named. And this would typically be the case for a retirement account. Let's say your spouse owned a 401k, named you, the surviving spouse, as the primary, 100% primary beneficiary. And that's part of the retirement plan agreement. You simply provide the administrator to the retirement plan, to the 401k, with the death certificate, and they will automatically transfer that asset, that account, either into a retirement account that you own, or they can set up a new so-called inherited retirement account that you would own. Then the last method of transfer is the only one that will involve a court process, and that's probate. This is the process that needs to take place for any asset that doesn't fall into the first 3 categories. So let's take as an example, if your spouse individually owned a brokerage account in his name and he didn't name any beneficiaries of that account, then the only way to move those assets to the rightful heir would be to look at a will. And the will would have instructions of where that asset would go, but the court would have to approve that process when it goes through a will. And then, of course, if your spouse did not have a will, it becomes an even more complicated process. But hopefully your spouse did have a will. And hopefully you don't have to go through probate at all, because the process does take time and can be expensive. The next near-term action I want to talk about is creating a financial plan. This is a plan to understand whether or not you can afford your financial goals, both in the near term and for the balance of your life. The chart here shows an example of a couple who did a plan showing that the likelihood that they can achieve their financial goals is just under 50%, 46% in this case. So effectively, these are a fictional client. We created projections for how much income would be coming in every year for the balance of their lives, how much expenses would be going out, and what we think that their investments, what kind of returns their investments will generate. And then the model runs various scenarios of different ways that the stock market could move, then determines a percentage, the likelihood they can afford their financial goals. And we can also do sensitivities off of that. So for example, what happens if we just spending downward? That's the middle scenario shown in this chart. Or what happens if they add some income? And so you'd want to create a financial plan to give you the comfort that you know you can afford your financial goals, or if you can't, then to at least know what levers you can pull to get you there. Investing, another critical financial task, not to handle immediately after your spouse's death, but hopefully within the first year. Now, hopefully you already had an investment plan. And the number one aspect or the number one element of a investment plan is a determination how much risk you can take. So this pie chart, there are two pie charts here. The one on the right, which is at the higher level, shows a investment portfolio, a mix of investments that has almost half of it in blue. That's stocks, that's risk, expected to grow more, but obviously can go up and down much more frequently and at greater extremes than either bonds or cash, which are in this pie chart in yellow and green, respectively. So hopefully you had a plan and hopefully at an appropriate level of risk. However, you may decide after some months after your spouse's passing, you may decide that you're not comfortable with that level of risk, in which case you want to look at your options and adjust it. And then finally, I want to talk about tax filing. On the right, I mentioned the tax filing that everyone is familiar with, which is your standard annual tax filing on Form 1040. During the year that your spouse passed away, you can still file as married filing jointly instead of filing single. This is important because married filing jointly is a more favorable. It will reduce your tax bill compared to filing singly. And then if you have dependents, you can also file, we call a qualifying widower status, which is the same treatment as married filing jointly for the 2 years after your spouse's passing. If you don't have dependents, then the year after your spouse's passing, you'll have to start filing singly. So you need to be concerned with the income tax filing process. But on the left, I mentioned two other items that may also be needing attention. First is a Form 706, an estate tax return. And the second is a Form 1041. Let's handle the 706 first. A 706 only needs to be filed if your spouse passed away owing estate tax. Currently, the estate tax exemption is $15 million. So if your spouse owned assets of more than $15 million, you would need to file a Form 706 and pay estate tax of 40% above the $15 million. So you might say, what if my spouse didn't have a $15 million estate, then I don't need to file that. Well, it's technically correct. However, by filing a 706, there still are benefits. If, let's take as an example, let's say your spouse passed away with $5 million to his name, then there's a $10 million unused estate tax exemption, the difference between the 15 that he could pass away with without owing estate tax and the 5 that he did pass away with. And you, as the surviving spouse, can claim that for yourself to use against your estate at your passing. You might say, yes, but I've got a $15 million exemption on my own, which you do, and I don't need another $10 million. But the problem is we don't know what the estate tax exemption will be when you pass away. So this $10 million that was your spouse didn't use of his estate tax exemption could potentially be valuable for you at your passing. So in many cases, it is worth filing the Form 706 estate tax return to claim that unused exemption. And then finally, the 1041 filing. This is to report income that was generated by any assets that your spouse passed away between the date of passing and the date on which those assets moved into your ownership or whoever was the beneficiary. So sometimes that process can take a few months. And if there was sufficient investments owned by your spouse's estate after he passed away and before they were moved into your name or the other beneficiary, then you need to file a Form 1041 fiduciary return. I hope this list has been useful. If you have questions, please reach out and good luck.